Something is seriously wrong in the housing market right now. For the first time in history, a brand new home in the U.S. is selling for $33,500 less than an existing home. This has never happened before, not even in 2005, right before the housing bubble popped. So what's going on? Let's break it down. So take a look at this chart right here by Reventure Consulting. You can see here that basically we've crossed this paradigm where my cursor is of existing homes costing $435,000 and new homes costing $402,000. And this is the median versus new existing prices. So if we keep going, it all goes back to March 2020. So this is how we got there, in my opinion. So when the Fed implemented the largest rate cut in history, mortgage rates collapsed. And by January 2021, the average 30-year mortgage hit a record low of 2.65%, which you can see right here. There was literally never a cheaper time in U.S. history to take out a mortgage or refinance. So as a result, most American homeowners, they locked in insanely low rates. You can see what happens in just a couple years. We went to basically 7-8% depending on your credit score. So 21% of these homes are actually sitting on rates below 3%, and 55% of homeowners today have mortgages below 4%. So that's 76% of the population that's sitting at 4% or lower. So this created the ultimate golden handcuff scenario. So if you own a house with a 3% mortgage, you can't sell without doubling your rate on a new home today, since average prices on a 30-year are about 6.6%. So we can see the distribution rates on outstanding mortgages. You can see that the biggest chunk right here, about 14%, 13%, is sitting between 2.75 and 3% on a 30-year fixed. Current rate right now, if we keep going, is about 6.59%, as I mentioned earlier. So if you take a look at this, you can see back in 2021 when we hit a low where my cursor is, and now we're sitting at basically almost triple that depending on what your credit score is. Again, we're sitting at about 6.59%. So the lock-in effect has completely skewed the housing inventory. So this is an inventory problem. Right now, 1 out of every 3 homes for sale is new construction. So for perspective, after the 2008 financial crisis, only 1 out of 20 was new construction. Just 4 years ago, about 16%. So today, for many buyers, new homes are literally their only option, or you're going to be paying out the nose for something a little bit older or something that you have to put some sweat equity into or some elbow grease into. So if we take a look at the affordability crisis as well, you can see at the same time affordability has collapsed. We're sitting at basically a record low going all the way back to 1986. So in 2023, mortgage rates nearly touched 8%, which I showed you earlier, for the first time since 2000. It's about 25 years now. So the housing affordability index dropped to about 90, the lowest ever on record. That means affordability has fallen by over 50% since 2021, which you can see right here. So we've got a record affordability crisis, homeowners are trapped in low rates, and builders are stuck with too much new inventory. This is basic economics. What do you think is going to happen to that new inventory? The prices have to come down. And also, we're going to be getting into rate cuts here in just a second. But before that, let's get into today's sponsor, Policy Genius. Did you know that half of Americans say they'd face financial stress within 6 months if they lost their primary income earner? That's where life insurance comes in, especially if you're for building a legacy for your family, just like I am. So a lot of people put it off. I get it. It's life insurance. It doesn't feel urgent until it is, unfortunately. But let me make it easy for you. Policy Genius makes finding and buying life insurance simple. They help ensure your loved ones have a financial safety net to cover debts, living expenses, or just to keep life moving forward, even if the worst were to happen. With Policy Genius, you can find life insurance policies that start at just $276 a year for $1 million of coverage. It's an easy way to protect the people you love and feel good about the future. Some options are even 100% online, and you can skip the medical exam. That's a win in my book. So here's what I like most. Policy Genius lets you compare quotes from top insurers in just a few clicks so you know you're getting the best deal. Their licensed agents aren't there to upsell you. They walk you through everything. They handle the paperwork and answer your questions with zero pressure. And if you're relying only on the policy through your job, be careful because it might not be enough and it probably won't follow you if you leave that job. This is a piece of financial planning that too many people overlook, but it's one of the most important. So if you're a parent, caregiver, spouse, or just someone who wants to make sure that their family is protected and leave behind peace of mind, make this the year that you check life insurance off your list. Secure your family's future with Policy Genius. Head to policygenius.com/whiteboardfinance or click the link in the description to compare free life insurance quotes from top companies and see how much you could save. That's policygenius.com/whiteboardfinance. Okay, so how are the builders responding to this? So I've always heard, houses are too big, houses are too big. So what are they doing? They're finally shrinking homes. So the median new home size fell to 1,792 square feet in January of 2025. In 2019, it was almost 2,000 square feet. So they're offering massive incentives as well. So we have builders over here that are publicly traded companies. We have Taylor Morrison. We got Lennar. I'll get into Lennar here in just a second. But they're also buying down mortgage rates for buyers by over 100 basis points. And if you don't, have your pinky and nose in the air, 100 basis points is 1%. A basis point is just 1/100%. So Lennar, they gave out incentives about 15.9% of revenue in some markets last year. So if we take a look at Texas, you can see sales incentives as a percentage of revenue. It's 15.9%, okay? So basically, this is not a normal market is what I'm trying to get at. But I do want to take a quick second just to read this. This is Cheryl Palmer. She's the chairman of the board and the CEO. This is Taylor Morrison Home Corp. So basically, she's saying instead of having just to discount the house to do a very expensive forward commitment, we're assisting a consumer, guaranteeing they're going to have 1% reduction to the market rate. We're talking about mortgages here. So let's say on average, let me take a $500,000 house with a 20% down payment, a $400,000 loan because you're putting down $100,000. To do that, it's costing me, let's say, approximately $16,000. So to get that consumer to the same monthly payment, it would cost me $60,000 to $65,000 in price adjustment. So when I can use these tools most efficiently to help that consumer, and I'm using $16,000 as compared to what we're seeing things in the market today that are 2.99%, 3.99%, those can cost 700 to 900 basis points. We're doing some of these programs at a fraction, and we're not taking it off the price, which is also protecting our margin. So let's take a look at the price gap and the outlook. So that's why in 2024, new home prices actually fell below existing home prices for the first time since 2005, and the gap is only widening. So if you take a look at this green arrow right here, the red dot, I know it's kind of hard to read, I apologize, I can try and zoom in. The red square, or the red line is saying new one-family houses sold annual median price. We have 417.4. I'm assuming that's in thousands, so 417,000. If you look at the green line, this is the existing home sales median price, which is 419. Okay, 419,000, and that's for today's video right here. When I was referencing, if you just look at these prices, this is kind of crazy. I was referencing back here in 2005. Look at the median prices just about 20 years ago, you guys. We're sitting at about 250 to 225. Okay, now we're sitting at 419. That's unbelievable. So history tells us this kind of shortfall, it's not going to last, okay? Something's going to give. Either existing home prices will come down in price or new home prices will bounce back up. So with the Fed set to cut rates starting most likely in September 2025, just about a month from now, the market could shift quickly, but there is another risk. And what is that other risk? You guessed it. Outside of housing, delinquency rates are already climbing, and what we're looking at is subprime auto loan delinquencies, baby. Obama phone, Obama cars. What is it? Cash for clunkers? Who remembers cash for clunkers? Who's as old as I am? So subprime auto loan delinquencies hit 6.2% in late 2024. This is the highest since the financial crisis. If that stress spreads into housing, things could get messy pretty quickly. So if we look at auto loan 60-plus day delinquency index subprime and prime is fine. Okay, this is kind of just a little bit sensational. So if you have good credit, you have some cash in the bank, you have, 700-800 credit score, prime is perfectly fine. But if you look at subprime, these are the people that probably got stimulus checks. They got, they bought some crap coins. They gambled in the casino. They did whatever. And now guess what? Those credit card bills are due. And now so is your car payment that you bought. So this is a little bit sensationalist because prime is perfectly fine. And same thing with foreclosures, you guys. The loan to values are much lower. So I don't want to be sensationalist, but this is pretty interesting. The other thing that I don't think this takes into account is that houses are smaller, the ones that are for sale right now. So yes, they are new. Yes, let's be honest. These new houses are put together in 90 days, you guys. Okay. They're made from wood. Okay. Who builds houses from wood? You go to Europe, everything's cinder block, clay, clay roofs. They survive wars. This, dude, whatever. I'm going off on a tangent. But my point is that the existing houses for sale may be significantly bigger in square feet. I don't have those metrics, and maybe that's why those prices are changing. But that's always been the case, right? Maybe now, since the new builds are coming down in square footage, as I mentioned earlier, maybe that has something to do with it. So as always, the big question is this correction going to come from existing home prices dropping, or is it going to be new home prices rising? Something's going to break because history shows that this gap is not going to last. Every single chart we saw, you guys, it was basically a little parallel. And then this is the first divergence we've seen since 2005. So what do you think? Are we headed for a housing crash? Just a rebalancing? Drop a comment below with your thoughts. I personally don't think so. All the correction videos I made 3-4 years ago, yeah, those are happening. Look at Austin, down 15-20%. Look at Florida's. Look at the coast. That all happened, okay? So again, I never called for a recession or a crash. It's just the correction, you guys, and that's exactly what happened. So as always, if you found this video valuable, share it with a friend, share it with 13,000 friends, obliterate the like button, and also hit the subscribe button as well. Thank you so much, and have a prosperous day.